Hello, welcome back to Fiscal Flows. This is part 2 of Balance Sheet Explained. Today we're going to go through liabilities. Earlier we talked about assets. Go back if you want to rewatch it or if you haven't watched it already. So we're going to be using Caterpillar again. And this part we're going to start with the two parts of liabilities that exist here. There is a current liability and then you have non-current liabilities, and they're also separated in the same way as assets, as explained earlier, where current liabilities are short-term within 12 months, and then you have non-current liabilities which are over 12 months and can be, for example, a debt that they owe like 10, 15 years, for example. So what are liabilities? Liabilities are, for example, what Caterpillar owes to other companies. So first of all, we have, for example, accounts payable, which is the money that Caterpillar owes to suppliers. It can be, for example, when Caterpillar buys steel, engines, or part from vendors and pay later. Since they pay later, let's say within 30 days, they get an invoice, then they basically add more to their accounts payable. It's basically what that they owe. And when they do pay for their liabilities, they remove from the accounts payable. So let's say they buy some engine for 1 million, then they add 1 million into their balance sheet on accounts payable. And then when they pay for it, they remove 1 million from accounts payable. And then we have the second one, accrued liabilities. These are expenses that Caterpillar already incurred, but hasn't paid yet. For Caterpillar, this could be, for example, wages, and this can also be bonuses, taxes, interest, and utilities. For example, let's say that some employees have worked for Caterpillar and during, let's say, a month, and they're not going to pay for it before the next month. Then they keep on adding basically what they owe to those employees, and then when they pay, they basically remove that off the balance sheet again. And then we have the third one, short-term debt. Short-term debt. This is borrowing Caterpillar needs to repay within 1 year. This could be short-term bank loans, for example, or the part of the long-term loans that are coming due soon. And then we have other current liabilities. This is just a bucket for everything else. For example, customer deposits for machines that they haven't received yet. It can be taxes payable. It can be warranty liabilities or just deferred revenue. And then we have the other section, which is non-current liabilities. This is long-term debt. And long-term debt is basically just bank loans for example, if they want to finance a factory, for example. And these are again loans that last more than 1 year. Last one is other non-current liabilities. This includes all other long-term obligations Caterpillar has. For example, if they have pensions that they have to pay for employees in the longer term, or if they have long-term lease commitments, they have deferred tax liabilities. These are longer-term promises that the company must fulfill. And then we have another section as well, which is as important, is also a liability, is equity, and this is what the company owes to the investors. This will be it for now. Thank you for watching, and if you have any questions, please write down in the comment section, and then also don't forget to like and subscribe. See you in the next one. Thank you.